Hey everybody, what's up? It is Monday, April 22nd, and it is Monday, which means I sent out the new edition of MMT Trader. If you want to get a copy of that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. I will send you the issue, and you can also check out all the back issues. Anyway, so let's talk a little bit about what's going on. Very interesting developments in bank credit. As you know, bank credit is one of the primary things that I look at in addition to, of course, the fiscal flows being the most important and the foundation for the analysis. Fiscal flows, of course, I'm talking about government spending, net government spending. Bank credit, very, very important as well. These things drive economic conditions. They are not reflective of what has happened in the economy. They literally create the conditions in the economy. Now, and by the way, bank credit, I was talking about that last year in November and December when we had the big correction in the stock market and everybody was panicking and everybody was talking about recession is coming, and some people were even saying it would be the worst crash since the 2008 financial crisis. And I said, no, that is not happening. We are seeing a big acceleration in demand and creation of loans and leases and other elements within bank credit. And that was telling us that the economy was re-accelerating. And of course, we are seeing that in the numbers. Now, GDP is forecast for the first quarter. The Atlanta Fed has it at 2.8%, which would be higher even than the fourth quarter, significantly higher than the fourth quarter of last year. Anyway, here's what I want to talk about, because in the latest numbers in bank credit, there has been a very sharp deceleration in the growth rate of loans and leases. Now, this may be pointing to something. Remember, it's demand for credit that really drives the creation of bank money or credit, whatever you want to call it. So that deceleration in the growth rate, it's something to pay attention to, because it may be signaling a slowdown in the economy. But I get into this in the report, and I talk about why there may be a technical reason behind the slowdown. Very important to understand the distinction between something that may be happening as a result of a slowdown in the economy or something that is of a technical and temporary nature that may reverse. Important to know the difference and important to be able to isolate that difference, and I talk about it. Now, one of the things that I do which nobody else does, in addition to just about everything that I do that nobody else does, is understanding the relationship between bank reserves and bank credit. And most people, or I should say just about everybody else who looks at this, has it wrong. They have it backwards. They think we live in the world of the Jimmy Stewart Bailey Building and Loan Association where the banks lend out reserves. That doesn't happen. Reserve flows, which move into the banking system and out of the banking system largely as a consequence of government spending and taxation, they have an effect on bank money or bank credit creation. Now, when you understand that, that gives you amazing inside information. Like, you literally know beforehand, way beforehand, when you can have these periods of expanding credit and then a slowdown in that process. And that influences and impacts the markets. That drives the markets. It drives the bond market. It drives the stock market. It drives currencies. It drives gold and commodities. When you know this and when you have this knowledge and understanding, I mean, that is like having big time inside information, but of course it's completely legal. It's just knowledge that nobody else has and that nobody else pays attention to. and in most cases that most people have a backwards understanding of. So it's something we can use, once again, another thing, a very powerful thing that we can use to trade the markets and be way ahead, a step ahead, 3 steps ahead of everybody else. I mean, that's the reason why I was able to call the turn in the economy, the turn in the stock market. That's the reason why I was able to be very, very calm during that stock market correction back in November and December. And looking at what I see right now and being able to understand why that is happening, that's very, very significant information. And it's information that I can use, or my subscribers can use to their advantage to profit. So that's in the report today. I talk about that. If you want to check it out, again, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. Now, on Wednesday, we will have a meeting of the Bank of Canada. It will be a rate decision. There is no rate change expected. However, they will come out with a statement, and it will have, I think, a significant impact on the Canadian dollar. I talk about that today as well. Finally, oil prices today jumped up to a 6-month high. Of course, we've been long oil since the low 40s. Oil prices at a 6-month high when the Trump administration announced there would be no extension of the waivers on Iran oil. Now, as the Saudis said, they will supply the market with whatever is needed, but the question is, when will they do that and how much? This is not going to be another repeat of the oil market crash in the 3rd and the 4th quarter of last year. The Saudis saw that happen. They got played for patsies. And I said this weeks ago. I said they're not going to get stabbed in the back twice. So it's very important to understand what their position is on this. And I talk about that as well in the report. So again, if you want to get the report, go to my website, pitbulleconomics.com, sign up, and send it out to you. Have a great evening. Talk to you tomorrow. Bye-bye.